Is now the right time to invest in Disney stocks, or should you consider selling? Navigating the ebbs and flows of the stock market, Disney's financial landscape recently presented a tapestry of both promising gains and notable challenges. In their latest earnings report, Disney showcased an adjusted earnings increase of 30%, reaching $1.21 per share for the second quarter. This marks a deceleration in their previously robust growth trajectory. Revenue-wise, Disney reported a modest increase of 1%, totaling $22.08 billion, which surpassed profit forecasts yet fell short of revenue expectations. On the streaming front, Disney Plus subscriptions rose to 153.6 million, although this figure was below expectations and showed a decline from the previous year. The company's direct-to-consumer services painted a brighter picture, with revenue climbing 13% to $5.64 billion. The operating profit for Disney's direct entertainment business turned around from a loss of $587 million last year to a profit of $47 million this year. With these mixed signals, let's dive deeper into Disney's financial health. Disney reported a 30% increase in adjusted earnings, but what's the story behind these numbers? Let's delve into the details. This quarter, Disney's earnings grew to $1.21 per share, a noteworthy rise that indicates a significant rebound in operational efficiency and strategic profitability. On the revenue front, Disney saw an increase, albeit a modest one, to $22.08 billion. This figure surpassed profit forecasts, but fell slightly short of revenue expectations. Now, what drove these results? A key factor was the performance of different sectors within the company. The Parks and Experiences segment, for instance, saw a 10% rise in revenue, reaching $8.39 billion. This increase is particularly impressive, considering the ongoing recovery from global disruptions. The revenue from Disney parks alone climbed to $7.48 billion, exceeding forecasts and highlighting the enduring appeal of Disney's flagship attractions. Furthermore, Disney's direct-to-consumer services showed promising growth. The revenue from these services increased by 13% to $5.64 billion. This includes Disney Plus, which now boasts 153.6 million subscribers, despite falling short of expectations and seeing a decline from the previous year. Hulu, another feather in Disney's streaming cap, recorded a 1% growth, reaching 50.2 million subscribers. The live entertainment business turned a new leaf by reporting an operating profit of $47 million, a stark contrast to the loss of $587 million a year earlier. Total revenue from live services rose 12% to $6.12 billion, with operating losses narrowing down to $18 million. Sports streaming services like ESPN Plus faced challenges, marking an operating loss of $65 million. However, this sector's overall revenue from sports increased by 2% to $4.3 billion. While earnings have shown a robust increase, revenue barely met expectations. In the competitive streaming market, how does Disney Plus stack up? Disney Plus has shown a notable subscriber increase to 153.6 million, although this figure did not meet the bullish expectations set for it. This growth, while significant, marks a deceleration compared to previous years. In contrast, Hulu, another jewel in Disney's streaming crown, has maintained a steady growth pace, ticking up to 50.2 million subscribers. This modest 1% increase reflects a saturated market, but also indicates a stable user base. On the sports front, ESPN Plus faces its own set of hurdles, reporting an operational loss of $65 million this period. Despite these financial challenges, ESPN Plus remains a key player in Disney's strategy to dominate sports broadcasting, which includes extensive live sports coverage and on-demand services. Amid these varying performances across its platforms, Disney has been agile in securing strategic partnerships and renewals to bolster its streaming services. A notable collaboration is with Kroger, where Disney Plus will be offered as a perk to members of the Kroger Boost delivery program. This partnership is expected to widen the subscriber base by tapping into Kroger's extensive customer network. Furthermore, Disney has renewed its crucial NBA broadcast rights, committing an average annual fee of $2.6 billion. This hefty investment underscores Disney's commitment to maintaining premium content on its platforms, ensuring that sports enthusiasts have a reason to subscribe and stay with ESPN+. Despite these ambitious moves, the streaming landscape is fraught with challenges, not least from competitors like NBC Universal, which is reportedly readying a $2.5 billion bid to snatch some broadcasting rights from Warner Bros., Discovery, and TNT. This move could reshape competitive dynamics and pressure Disney to innovate continually. Disney's streaming services are expanding, though not without their challenges. The company's ability to navigate these waters with strategic partnerships and content investments will be crucial in maintaining its competitive edge in the fierce streaming industry. Disney parks have always been a core part of the magic. How are they performing financially? In a remarkable display of resilience and growth, Disney Parks and Experiences have reported a 10% increase in revenue, reaching $8.39 billion. This significant uplift is not just a number, it's a testament to the enduring appeal and evolving experience that Disney parks offer worldwide. So, what's driving this impressive growth? A mix of strategic expansions, enhancements in guest experiences, and a rebound in international tourism has played pivotal roles. Disney has continuously invested in its parks, introducing new attractions and updating classic ones, which keeps the magic fresh and compelling. For instance, new themed areas and technologically advanced rides attract a wide demographic, from families with young children to thrill-seeking adults. Moreover, Disney's mastery in creating immersive experiences is unparalleled. From the moment guests step into a park, they are transported into a world where storytelling comes to life around every corner. This unique offering not only boosts day-to-day attendance, but also increases spending on merchandise, food, and special experiences. The potential sustainability of these revenue streams appears robust, with plans for further expansion and the integration of the latest technology in entertainment and customer service. Disney parks are set to captivate guests and drive financial growth for years to come. Disney parks continue to be a strong revenue generator, surpassing expectations. Sports are a significant part of Disney's portfolio. What's the current play? In the vast arena of sports and entertainment, Disney continues to make significant strides. The sports sector alone has seen a 2% increase in revenue, reaching a substantial $4.3 billion. This uptick is a testament to Disney's robust engagement strategies and broad appeal across various demographics. However, not all is smooth sailing. ESPN+, a key player in Disney's sports streaming arsenal, reported operational losses of $65 million. This figure highlights the challenges of maintaining profitability in the highly competitive streaming space. Despite these hurdles, ESPN+ remains a pivotal platform for sports enthusiasts, offering an array of exclusive broadcasts and content. In an exciting development, Disney is not just playing defense, but also going on the offensive with new ventures. A notable initiative is the joint venture with ESPN, Fox, and Warner Bros. To launch a new sports streaming service in the United States. This collaboration aims to reshape how sports are consumed, combining the strengths of these entertainment powerhouses to offer viewers unparalleled access to live sports and related content. Moreover, Disney's proactive approach is seen in their efforts to secure and renew lucrative deals, such as the anticipated annual fee of $2.6 billion for the NBA broadcasting rights. These strategic moves underscore Disney's commitment to enhancing its sports offerings and securing long-term growth in this sector. While sports bring in revenue, the operational side shows some strain. Every move Disney makes affects investors. What should you know? In the intricate world of corporate strategy, Disney has been a central figure, navigating through high-profile boardroom battles and significant political negotiations. Recently, the company emerged victorious from a notable confrontation with Trian Fund Management and Blackwell's Capital. This battle was more than just a corporate skirmish. It was a public display of Disney's resolve to maintain control and direct its future, a move that reassured many investors about the firm's stability and governance. Simultaneously, Disney's interaction with political landscapes has been equally strategic. A case in point is the recent settlement with Florida Governor Ron DeSantis regarding the Central Florida Tourism Oversight District. This agreement marked the end of a tense standoff and showcased Disney's ability to negotiate terms that could safeguard its massive park-related investments in the region. Such resolutions are crucial as they directly impact operational freedoms and future expansion plans. Market reactions to these events have been mixed, but generally positive. Following the resolution of the board dispute and the settlement in Florida, Disney's stock saw an uptick, reflecting investor confidence in the company's leadership and strategic direction. This was a clear indication that the market favors a stable governance structure and well-negotiated political agreements, especially for a conglomerate like Disney, whose operations are vast and varied. However, strategic maneuvers are not without their challenges. The need to continually invest in content and innovation, while managing expansive operational costs, puts constant pressure on the company. The fluctuating performance of Disney's stock in the days surrounding these events highlights the market's sensitivity to both internal corporate actions and external economic factors. In conclusion, Disney's strategic decisions in the boardroom and its negotiations on the political front have played pivotal roles in shaping investor perceptions and market stability. These actions, while sometimes controversial, have ultimately contributed to the company's robust market standing. Strategic maneuvers have both boosted confidence and presented challenges. After dissecting Disney's financial and strategic landscape, what's the verdict? Walt Disney has shown a vibrant mix of triumphs and challenges. On the financial front, Disney reported a 30% increase in adjusted earnings, reaching $1.21 per share this quarter, signaling a robust profitability despite a slowdown in growth momentum. Revenue saw a modest rise of 1% to $22.08 billion, slightly missing revenue forecasts, but exceeding profit expectations. Subscriber growth in Disney Plus has increased to 153.6 million, though it fell short of expectations and last year's figures. The Parks and Experiences segment, however, painted a brighter picture with a 10% increase in revenue, showcasing the enduring appeal of Disney's physical venues. On the flip side, operational losses in some areas like ESPN Plus indicate ongoing challenges in the sports streaming domain. Your investment decision should weigh these insights carefully, considering both the magic and the